One of my favorite YouTube channels is Anderson Business Advisors with Toby Mathis. And it just so happens that's our guest today on our show, Mr. Toby Mathis. Super excited to you to be here, sir. And a little bit about Toby. He is one of the founders of Anderson Business Advisors, attorney. Um, his YouTube channel has close to 500 videos. He's got almost 200,000 subscribers, and he's all about teaching no nonsense legal advice for people like us that are searching for financial freedom. So, Toby, welcome to the show.
Hey, thanks for having me. Thanks for the introduction. It's
Yeah.
very nice.
So, for those of for those out there that may not be familiar with you and what you do, can you give us a little brief background?
Yeah, absolutely. Number one, I'm a tax attorney by trade. I became an attorney something like 25 years ago, and I've been trying to make up for it ever since. I didn't become a lawyer because I loved lawyers. I became a lawyer because I was working with a business guy. It was almost like a mentor to me, and he said, "You better learn this stuff because they'll screw up your deals otherwise." And fortunately, lawyers have a little bit of a reputation, right? We love them, but there are some bad apples out there. And that's really what we first started focusing on. I'll say myself and my partner, Clint and Michael. Um, we really were like a laser beam on asset protection and tax savings because those are the most likely ways somebody's going to take away your hard-earned money. And then really it's kind of progressed. The legacy side is something I'm very passionate about now. If you've ever heard of the book, The Second Mountain, it's kind of we worked so hard on that first mountain of becoming established in our profession and getting through all the kind of the ego stuff. And then you realize what else is there, and you're starting to create the legacy for your family or affect organizations. It kind of shifts. And I
Yeah.
really love that second mountain that people are climbing. They tend to have a lot more passion in it than just making the money.
Right.
In your profession with doctors, especially, they work so hard getting on the top of that first mountain and establishing themselves in their professions. And then it's kind of like it's kind of a letdown. What next? They
Yeah.
feel, what am I supposed to be doing? And it's really cool when they start to say, hey, you know what? I want to affect change in communities. I want to affect change in society. Not everybody does it. I'm not, I don't judge anybody that doesn't do that, but obviously that's the stuff that it just gets the juices flowing.
Absolutely. So, as you mentioned, doctors. So, we have physicians, dentists, we have attorneys, we have busy professionals that watch this channel, and typically we get out of training. We go to school a long time. Many of us get out with a lot of debt, and we start off later, in our financial career. And because we have this, sort of delayed gratification for so long, many of us like immediately jump into a lifestyle. It's like putting us in these golden handcuffs, which basically erodes any real chance of building real wealth. So, what do you have to say about that?
I will share with you an experience. So I was working with another doctor group, and it was really interesting. They had these financial professionals rolling around from the banks, and they had this $1 million loan you automatically qualified for while you were in your residency. And I'm like, wait, that means they get out of, I know they do the medical school and then go into residency. Are you telling me that you'll give a no doc loan to doctors in their residency? And they said, yes, for up to $1 million, we'll let them buy that. That's the mortgage. So they'll let you buy $1 million house plus, whatever else you could scrape together, but up to $1 million. I don't remember the percentage. It was really, really low. It may have been 100%, but it was like one of those things where I can't think of a worse situation. You're working your butt off. You're probably doing 50, 60 hours a week, right? And somebody comes along and says, by the way, I'll let you buy $1 million house while you're doing that. And to me, the immediate thing I thought about was click, click of the handcuffs going on around your wrists as they're immediately putting you into indentured servitude.
Yeah.
I'm sorry if that's offensive to some people, but I always think of it as like it's almost like they're escorting us into the golden cage saying, just come right here. And then shutting that door. And you're like, but the bars, they're made out of solid gold. They're so beautiful. And I mean, I can relate to that. I have a lot of clients that relate to that, but they get you because they know that you'll have a huge career ahead of you. You're not going to get rid of that debt. You know, you're going to be a great client for life of that
Mhm.
institution. And you know, and when you're the debtor, it's going the wrong direction.
That's
I'm
true.
say.
Now, in your book, I love your book and Infinity Investing, the how the rich get richer and how you could do the same. I love that subtitle. But one of my favorite chapters is actually chapter one, where you talk about the meaning of financial freedom.
Mhm,
Now, I've got calls on a weekly basis with typically new members of my investor group, and it's
mhm.
really hard to believe that they reach out to me for something because they're looking for financial freedom goals, and even more importantly, they have no purpose, like why they're trying to do this. So, can you talk to us a little bit about that, like what the meaning of financial freedom really is?
Well, it's the old Simon Sinek, the getting to your why, like why are
Yeah.
you doing what you're doing? Um, to me, it's when I ask people, and this is kind of cheesy, let me set the stage.
Okay.
I grew up very modest. I when I went into private practice, I did not work for a firm. I hung my shingle out on day one, and I ate crud for 3 or 4 years. Where I'm talking like diving into it was hard enough being a student going through school. I was working 2 and 3 jobs to get myself through school without a lot of debt. I'm just one of those guys that's opposed to debt. Um, but where you're looking through the cushions to find money so that you can buy the JoJo's, the old potato slices, so you get some
Hmm.
calories in you. Like I know what that's. I remember that distinctly. Now I have over several hundred properties, over 300 properties, and somewhere along the line, there was a little bit of a psychological shift where you realize, wow, I was not happy chasing things. You kind of look and say, what's success? A lot of people think a big house, really nice car, living in a great neighborhood. And then you realize, no, that's just stuff. What's my purpose? And you start changing. I kind of mentioned the second mountain. You start looking at like, what am I actually passionate about? It might be spending time with your kids. Maybe it's coaching. Maybe it's traveling. Maybe it's doing mission work for your church. Whatever it is, that's your reason of like, hey, if I had more time, this is what I would do. That becomes kind of your why. And financial freedom means you can do that whenever you want. So I look at it this way, like how long could you survive at your current lifestyle if you quit your job, or if you lost your job, or if you became ill and weren't able to work? How long would it take? Would it be before you exhausted all your resources? You sold your house, you sold your cars, you sold your boats, you sold your RV, you sold all the cool stuff you have. You liquidated your account so that you could live. And to me, when I titled Infinity Investing, it was an infinite number of days that I could live off of passive income sources like rents, royalties, interest, even short-term capital gains when you sell stocks, when you sell options on stocks, I should say. We do covered calls. It's one of the strategies in dividends, in rents, things like that. So it's rents, royalties, dividends, interest, and short-term capital gains off the sale of calls. I
Hmm.
just look at those 5 income sources and I say, if that is not enough to cover your monthly expenses, then there's a finite number of days that you could survive without working. So once you have enough from those sources, and I know you do syndications and you're into those types of investments. If the syndications and your investments are not covering your expense, then unfortunately you have a number of days that you could survive. And most of us have this number of days. We don't realize it. It might be, hey, I could survive 90 days before I'm selling off my stuff. Maybe if I sold all my stuff, like in this market, it would be a bad time to be selling your stuff, right?
Right. Right.
I I have $1 million house, but nobody will give me $1 million for my house. It means you don't have $1 million house, which we don't. We'd have to test the market. Maybe it's a $700,000 house, right? And all of a sudden you have no equity, and you're walking away and hope you like it's not the saving grace that you thought it was. So I look at that and I say, how many days could you survive off of your current asset base if you left your employment? In your work, like you could no longer trade your time for money. If it's a certain number of days, then we want to change that into an infinite number of days by replacing your expenses with the infinity income sources. And it's super easy to do once you know. It's just like, I'm not a doctor. I have a doctorate, but I always joke with my kid because she's in med school. I'm like, hey, I have a doctorate. Does that mean I can do small procedures? And she just goes, Dad, shut up. Um, but you're a doctor, so you need to know what's the cause of the problem, right? You need to get information so you can provide an adequate diagnosis and then decide on a course of change behavior. It's no different in finances. We just don't know how to diagnose it. You know that you feel like you're overwhelmed. You know that you feel like there's a weight on your chest. You know that you feel like you're running ragged and you don't see an end to it, but nobody's done the diagnosis. Yeah, you are literally, we call it the losing loop. You're working to cover liabilities. You're working to pay the liabilities instead of working to buy assets that pay for the liabilities. In other words,
Mhm.
you're doing all the heavy lifting. You have it all on your shoulders, and it starts to wear on you over time. And I can't imagine, like I can't imagine because I've worked a lot, but I can't imagine if you're treating patients all day, how intensely frustrating that must be if you come home and you feel like there's still a pressure. It's got to be debilitating for some folks where they don't know where it's coming from. They have the beautiful house, they have the beautiful life, they have the great cars and stuff, but they still feel this horrific pressure because they know they're not financially free. And once you start doing that number crunching, it's a little bit ugly at first because you may not like what you see. Hey, I thought I was a millionaire, but it says here I'm going to last 2,000 days, which means I can't really retire anytime soon.
Mhm.
Right. That's got to be frustrating for a high income person. And it's just shifting it and saying, you know what, I'm going to buy these particular types of income sources and I'm going to calculate exactly how much I live off of. And once I know those numbers, once I can get that passive income exceeding that, now I don't have to worry anymore. I could live for as many days as I need without depleting my asset base, and I'll be okay. That's like I've had folks in their 20s hit it. And it's funny because they keep their expenses really low and they're kind of doing the opposite, where they're like, hey, I'm just going to live really, really frugally. Okay. But then you buy assets that allow you to, like if you want a Lamborghini, I say, I'm not going to tell someone not to buy a Lamborghini. That's Dave Ramsey's job to tell you you can't have nice things, right? I'm going to say, don't work for the Lamborghini. Buy a couple rental properties and let them buy your Lamborghini, right? Let your tenants pay for your Lamborghini. I'm just never going to sit there and say, don't. What I'm going to say is, don't you be the one that provides the labor for it, because then you're in that kind of that losing loop where you're working really, really hard for something that's not really an asset. It's really a liability. That could be a frustrating experience once people wake up from it and they go, oh my God, I'm working for this stuff and this stuff has no real value. Why am I doing that? Why am I trading my time for that? And we'll just shift the gears a little bit and say, you know what, let's buy assets. And then once you have enough assets, you can buy whatever you want. You may not even want to at that point. You may look at it and go, yeah, I worked really hard. I got this beautiful cash machine running and it's churning out this money. I don't really need the Lamborghini. I think I'll go on vacation with my wife.
Mhm. Which kinda leads us to, what you're talking about with us and, going to law school or medical school or dental school or whatever, and we learn our trade, and we get a lot of, for us, we get a lot of clinical training, but again, we don't get any financial education, really, really nobody does. So,
Mhm.
when we graduate, we're like hounded by like the insurance people, the financial advisors, they're just like flocking to us. Hey, can I take you to lunch? And blah blah blah. So what was really funny in your book, and I wanted you to, maybe talk a little bit about was speaking of financial advisors and financial institutions, you mentioned a story and you said it was actually, I think it was made public about a Morgan Stanley employee
Yeah.
that, he was working at Morgan Stanley and then he got his statement, his retirement account statement. He's like, wait a minute, in my retirement plan, you guys are putting in all these really expensive, high management fee, underperforming products that I'm selling on a daily basis. Why are you doing that to me? That was actually a true story, right?
Yeah, it was actually Morgan Stanley's 401k. They sued for breach of fiduciary responsibility. There wasn't a fiduciary responsibility. There is now. I think they changed the laws in retirement plans at least, but at the time, you did not have a fiduciary responsibility to the participants in your plan. And here, let me make it really understandable to all you doctors and all you professionals out there. Like, I have a fiduciary responsibility to my clients. When a patient comes in, you're supposed to put their needs before your own, right? That's a fiduciary relationship. Unfortunately, that same rule doesn't exist in financial services. So there are fiduciaries like CFPs and things like that, or in a particular state, they may say if you sell products inside a retirement plan, now it has to meet a fiduciary standard. All that means is that they have to put your needs before their own. That doesn't always exist. And a lot of financial advisors, it would be akin to this. Let's say you walked into the butcher shop and you said, what should I have? I'm planning my menu. What should I have for dinner this week? And I'm going to do a 7-day menu. The butcher's going to look at you and go, well, I have some veal over here. I got some nice ribeye over there. Here's a pork loin. Here's some more steaks. I got some New Yorks. And what else do I got? Oh, I got some brisket, right? They're going to have a plan for you that you'll end up eating nothing but meat for the week, right? You'll end up eating whatever they have because they're going to sell you what's in their counter, regardless of whether it's in your best interest. Now, if you went to a doctor and a nutritionist and you said, what should I be eating? It would probably look very, very different because they don't have anything they're selling you. They're going to look and say, hey, maybe we should do some blood tests, right? Let's see where you're deficient. Let's see, like, hey, the last thing I'm going to do is feed you stock full of red meat if you have high blood pressures, you maybe have an underlying condition, whatever, but they're going to look and see what's in your best interest. A lot of times when we're talking to financial professionals, we're talking to a butcher and we think we're talking to a nutritionist. And you think they're doing the best, they're looking out for your best interest, when in actuality, they are just selling you whatever they have to sell and whatever the highest margin is, and maybe whatever's closest to expiration. So the Morgan Stanley case is essentially that. This is a Morgan Stanley employee who was actually a regional manager who looked at their plan and said, holy cow, our retirement plan is full of all the crap that you shouldn't be eating. Like, why are you guys doing this? You're breaching your duty. The court ended up throwing it out, saying, hey, they didn't breach the applicable standard because there wasn't a fiduciary responsibility there. And that's kind of the punchline is the Morgan Stanley employees sued their own employer for buying Morgan Stanley products in their retirement plan.
That's crazy.
Yet they're selling those products every day to their customers.
Crazy. That should be a wake up call, to be, really. It's so hard for us because we just don't get any education, and we're putting our trust in these people that we don't have time to do all this. So that's one of the reasons why I started my site and my channel was just to educate people. Bringing on people like you and other people. They're not, quote, selling anything. I mean, you have a book. If you want to buy the book, that's great. I mean, I love your book. I don't know, it was $15 or something, but I mean, $15 to educate yourself. And then then if you at least know what the options are out there, and like you said, you go to the butcher, you may want to go to other different stores. So now I can see, hey, I've got all these options besides the 401k that I have to work for 40 years with this particular thing, and they just churn me, right?
And what's going on in the 401ks, which is more like a 201k at this point in the market, right? Is they put it into certain funds and you're being charged on average. There was a Forbes article that was written on this, and they broke down the soft dollar cost, the tax drag on all these things, mutual funds in general. There's a cost of about 4.8 to 5.8% a year. They'll disclose an expense ratio that might be in the 1 or 2, and you'll think that's all it costs, but it doesn't. There's a management fee on top of it. So I just tell people, measure the output. It's not rocket science. Say if I have $100,000 in my plan at the beginning of the year, how much do I have in my balance at the end of the year? If it's 103,000, I made 3%. I don't care what they tell me. They may say, hey, your fund is up 6.2%, blah, blah, blah. But by the time they take all their fees out, I may only net 3. And if you just do that with everything, like if I look at real estate, I don't care what a realtor tells me a property is worth. Hey, the comps down the street are this, or this is what prices are going in this neighborhood. If you're an investor, you don't care about that. You say, how much am I going to generate on my money? What's my cap rate? What am I actually going to get paid on it? And if you
Hmm.
just look at everything that way, hey, I don't care what my tax guy says. Hey, you should do this XYZ. This is a great investment. What I want to say is, what's my net going to be? So from a tax standpoint, a dividend may net me more than if I was an option writer. By the way, don't be a stock trader. I've seen more people lose their katush buying options. Be the seller, be the casino, don't be the gambler. And if you're out there, I always get hate mail when I say that. It's about 5% success rate if you're an active trader. So I love my active traders. I have a few of them that are there, and they always yell at me. And I'm like, as well as I do. It's no different than if you are a professional poker player. For every one successful poker player, there's like 9 that have burned their life to the
Hmm.
ground. Right? They're divorced. They've lost everything. I understand that you're one of the successful ones and you did the gauntlet, but please don't do stuff like that, right? We want to be in the position where it's paying us better. The tax code tells us what types of income we will get to keep more of. So if I make $10 as a doctor, for example, or as a lawyer, I might, and depending on what state I am, I might get to keep 50 cents. If I make $1, I get to keep half of it, because federal and state taxes and employment taxes, they just hit the heck out of it. Whereas, hey, maybe I'd be better off making 7%, but it's tax advantage. Maybe it's in real estate where I don't have to pay tax on it. I get the cash flow, and hey, it's great. I might be better actually with a lower yield, but a higher net. And the
Hmm.
only way you're going to know that is if you know how to actually calculate it, or if you work with people that do.
Yep. Because, for us, our biggest wealth building tool is our income. We
Yep.
went to school all this time. So, and if we start taking our time away from that, trying to do all this stuff, it's just going to, as you see, it either takes time away from our business or practice or from our family or both. So that's why I think educating ourselves as much as possible, is the key. Now, as somebody that likes to mentor young people,
Hmm.
I love what you said in one of the chapters in your book about the number one difference between the wealthy and the poor, because you talked about empowerment, empowering people, being around other like-minded people,
Hmm.
and getting that right mindset. So, for somebody out there that maybe doesn't have the right mindset, or is just in the mindset of I've got to go trade time for money,
Hmm.
pay a lot of taxes, and that's how I operate. What would you say to that person in order to get them to start thinking differently?
So I would break it into really simple, easy, bite-sized pieces. So our mindset changes our behaviors, and our behaviors change our results. So if I'm scared to go through a door because I'm convinced that on the other side of the door there's a monster that's going to eat me, I don't care. Anybody could try to explain it away. You have a fear of going through that door, right? So we have a
Right.
mindset that's changing our behavior. The behavior means I'm not going to open the door. So if you want to open the door, I'm going to have to convince you, like make it a rational statement of like, hey, here, maybe we open the door and look behind it. There's no monster there. Maybe that's how you overcome it. When you're looking at financial planning, the best behavior I could tell you is avoid debt and buy assets. It's actually, I can make it even simpler. Buy assets, avoid liabilities. A liability takes money out of your pocket every month. An asset puts money in your pocket every month. Is the simplest way. Assets feed you, liabilities bleed you. If that's all you did, and you said, hey, wait a second, that's true. If I buy a car, I have to put gas in it, I have to insure it, I have to pay registration, I have to pay interest on the lease, or pay interest on the loan on it. Boy, yeah, that's taking money out of my pocket every month. But I need a car, right? But hey, I'm not going to argue that you don't need a car. I'm just saying it's a liability. Your house, hey, I need a place to live. Yep. But If you buy a big house, you're going to be paying a whole bunch of expenses. That's a liability. So don't invest in liabilities. Your investment shouldn't be your house and your cars. Your investment should be in an asset. Well, what's an asset? An asset pays you quarterly, monthly, annually. It puts money in your pocket every year, like money that you could spend. I could go down to the grocery store and buy groceries with it. And that makes the world very small. When I look at the stock market, for example, it gets down to about 60 companies that continuously pay you. Day in and day out, year after year, they increase the amount that they pay you. If I went and I drew a time horizon of, hey, companies that have been doing this for greater than 50 years, we're down to 25 companies. Companies that have been doing this for 25 years, you're down to maybe 50 companies. Right. So like it, or 25 years been increasing their dividends. That's called an aristocrat. Kings of the 50 years or greater. The Coca-Cola's, Procter and Gamble, 3M's of the world. There's very, very few of these companies that continuously reward their shareholders and pay you. So it becomes very easy. If all we did is say, I'm going to buy things that cash flow, the world gets very small. All of a sudden, I'm looking at syndications that are cash flowing syndications. Hey, I'm looking at probably things like self-storage, mobile home parks, car washes, multifamily, things that right out the outset, that thing's going to be cash flowing, and it's going to be and if I never sold it, I'd be okay. Right? Because it's not going to cost me money every month. If I invest in the stock market, I don't care what the value of the portfolio is. I care what it's generating, because if I never am going to sell it, I'm going to hold it for an infinite period of years. I'm going to buy a machine that prints cash. Then I'm going to buy the Coca-Colas. I'm going to buy the 3M's. I'm going to buy the Procter and Gamble. I'm going to buy these companies, Federal Realty Trust. There's a bunch that are over 50, and I'm just going to buy them and forget them. Just continuously buy them. Well, the market's going down. Yep, just keep buying them. But the market's going up. Yep, just keep buying them. Right? Nobody can time the market. Nobody has the crystal ball. History shows us that if you just continuously buy good companies, great companies, you're like Warren Buffett. You're gonna do just great. And if what you're buying them for is the income that it produces, you're fine as wine, because that thing's going to be paying you. In some cases, it's monthly. Some cases, it's quarterly. In some cases, it's annually. You're going to have these assets that are paying you continuously forever.
Yeah. Well, I wanted to, which kind of leads us into the last thing I wanted to discuss was, and you kind of hit on it, the different types of income, because we only thing that we know is active income, treating patients or serving customers, which is, is the highest tax income. But then you talk about the three different types of buckets, the bad bucket, the better bucket, and the infinity bucket. So can you talk to maybe somebody, and again, it's all about mindset, because what you just said, our mindset when we go to a financial advisor, it's, they may look at your lifestyle and how much, when do you want to retire and all this? Okay, you need 8 million, you need 12 million, whatever. So that's
Dump
our
that out of your
mindset,
Yeah.
And when what you're talking about, it's okay, well, if I got $4 million right now in my 401k, how is that helping me now? If you're 45 years old, it's not buying groceries, So what you're talking about, again, it's that mindset shift. So can you talk a little bit about the different types of income, and then talk about those three buckets: bad, better, and infinity?
Yeah, I'll absolutely break it down. I can tell you the bad bucket right now is the worst type of income you can have. And I could just go to publication 55. Every year, the IRS publishes all of its data. Do you know the number one source of income last year for the government? It wasn't federal income taxes. It was employment taxes, old age, disability, and survivors Medicare. It's really close every year. It's like they're within, I don't want to say like a few trillion of each other, right? It's close. It's within a few percentage points. But we never seem to talk about the fact that there's this old age disability, the Social Security tax, the self-employment tax. It's the killer. It's the one that active income, you get hit with this. If you materially participate in a business, like you're in a medical practice and you're one of the partners, you're getting hit with this unless you're taking evasive action like using an S corp. This is the tax that I don't know about you, but I worked for McDonald's when I was younger. When I was 16, I made like $4 an hour. When I got my first paycheck, I was like, what are these things? Why are you giving my money to all these different groups? FUTA, SUTA, OADSI, all this stuff. Like, who are these people, and why are you giving them my money?
like a cell phone bill.
Yeah, I'm just looking at it going, there's not much left. I worked 40 hours. I thought I was getting $160. Why am I getting 120? Right? It's because that's who the monies go to. It's active income. They hit us with a surprise tax, and it doesn't go away. Anybody who says it goes away, it phases out on one portion and increases on another. You'll always have it. It'll always be like at least 3% to 4%. It's always going to be there. And when you're first getting started, it's 15.3%. It's a big punch on top of your federal income taxes, on top of your state income taxes. So the worst bucket is active earned income. Then there's, hey, let's defer that and move it out. So like your IRAs and things like that. Hey, I can defer it. I could I'm doing my 401k, I'm pushing the money in there, but I'll pay tax on it eventually when I'm 72, which is great. I'm deferring it and I'll pay ordinary income on it. I'll get hit with it. And then you have this beautiful bucket of, hey, I may never pay tax on any of the gain on my houses. I could actually buy a property. Let's say I bought it for 200,000. It goes up to 500,000. I could sell it and buy the 500,000. I could sell it for 500,000 and reinvest that in two other houses, as long as they're worth more than 500,000. And if I needed cash, I could just borrow against it. And then as those go up, maybe they're worth $1 million. I buy $1 million of property, borrow some more against it. I haven't paid a nickel in tax yet. And then I take those properties and I buy, maybe I sell those for $5 million and buy $5 million worth of real estate. And then eventually I pass away. You have a step up in basis. Your estate will pay zero tax on that. You will pay zero tax on all that gain. Let's say it's worth 10 million bucks. This is hard for people to understand. You pay zero tax. Your heirs will get that, and it'll have a new basis of $10 million, a new depreciable basis, which means then you get to write off. You never paid tax on it, and they're writing it off again. Yes, that's the beauty of real estate. Or let's say that you're a professional and you're making a lot of money in your active realm, and you're like, God darn it, how do I offset some of this? Well, one of the easiest things you could do is say, you know what? I like what I'm doing. I like buying properties. I like helping working class families. That's really important to me. And I like being a landlord. You could actually do that as a nonprofit activity. I could donate a house that I've had for 10 years. I've depreciated a bunch of it. I've gotten a bunch of tax benefits, but it's gone up in value. I'll use a real life example. Bought a house for a gal that was, she's blind. She was being foreclosed on. I went to the bank and bought the house. It was a friend of mine's mother. And I was like, I just did it just because it was the right thing to do. And I said, here's this house. I'm going to rent it to her. I'm not going to charge her anything. Just pay the property tax on it.
Yeah.
And I realized, wait a second, this house had gone up in value. It was in Winter Haven or Winter Garden, excuse me, Florida. And it tripled in value over the next 5 years. So I just gave it to charity. Maybe it was my charity, but I gave it to a charity. My deduction is the fair market value of that property. So my tax savings were actually more than I paid for the house. And it's in there forever. It's not part of my estate. Nobody will ever pay tax on it again. I gave the gal a life estate in it. Hey, you can stay in there as long as you need it. And then eventually it'll go to the charitable purpose, which is a stewardship company. So it's like, hey, there's lots and lots of need. It sounds like you're doing the same thing. But I look at it and I just look at it a little bit differently than others from a tax standpoint. I'm like, hey, how can I get benefit from these things? And could I even offset some of my other income? As medical professionals, dentists, attorneys, there's plenty of things that'll offset your other income out of that infinity bucket. And you look at that infinity bucket and you start saying, hey, what I know for certain is that I will never in that infinity bucket be hit with self-employment taxes. What I know for certain is that I'm going to get the benefit of even this thing called long-term capital gains, where it could be 0, 15, or 20%. I know for certain that I can use things like depreciation and offset. And all of those assets I can borrow against tax-free. And all of those assets, when I die, will step up in basis. And I'll never pay tax, and my heirs will get to take those assets tax-free. I I can focus just on those items and do a tremendous job for myself financially. If that's all I did, is I looked at the end result and I kind of back, hey, this is how I'm going to do my back calculations. Wow, this one's way better off than just working my katush off until I die.
Yeah, because I'll break down, like when I talk, maybe I'll talk to a dentist, and a good practice, for a practice owner. Let's say I'm like $1 million practice, but that it grosses $1 million a year. Well, about the average overhead that you're going to pay is about 70%.
Mhm.
So that leaves you with 300 grand. Again, depending on what state you live in, if you're paying 50% in taxes, that's $150,000 you have left over. So you're having to work your butt off to produce $1 million to, after the end of the day, you're making about 150 grand. And when you think about it, that's not really a whole lot of money where you could actually invest your money early on to replace that little, so you don't need the millions and millions of dollars that we think we need. You just need that 140, $150,000 a year, right? Is that kind of what you're saying?
Yeah, most people could actually retire. I've done the calculate. It's about 7 houses outright. If you own 7 properties, you'd probably be able to retire. Or if you had, I did the numbers off of Altria this last week, which is MO on the stock market. It's paying about an 8% dividend. If you wrote covered calls on it, you could generate a pretty good return. You could probably replace a big chunk of your income for, if I just took those two, for less than $1 million.
Hmm.
You could probably have a really good income source per infinity. That's indexed for inflation, like it goes up with inflation.
Right.
Right. So you don't need a tremendous amount of money. The way that financial advisors do it is they would say 25 times your earnings. So you're making $300,000 a year. They're going to say, hey, we need to put 25 times that. I'd have to get my little, what is that? 25 times 300,000. So I need to have what, 7.5 million put aside. Let me see, 1, 2, 3. Make sure I actually do this right. Yeah, 7.5 million.
Hmm.
That's a huge chunk of money. And then they're going to say live off of 4% of it. Right. That is a depletion strategy that if you live long enough, eventually you'll outlive your money. My mom's going through this. She's in her 80s and she sees the account getting smaller and smaller every year because she was doing that traditional way of doing her financial planning, which gets the anxiety when you're 90. Oh my God, I'm going to outlive my money if I hit 100.
Right.
I don't know why somebody would voluntarily put themselves in that situation versus, hey, let's just put it in good income producing properties and good income producing stocks. Quit goofing around with this trying to trade, quit trying to, hit home runs all the time. Just, hey, I know that the rents are going to be steady Eddie for the next 30, 40 years. I don't have to worry about it, and I build a portfolio that's generating $300,000 a year to replace it. By the way, did you know that you could probably offset, if not 200, but a good chunk of that $300,000 a year into a retirement plan? Just using a DB plan and doing kind of a reverse engineer plan, and then invest that in some of these assets too. Like, again, we tend to do things kind of in a backwards way in the financial world because there's so much motivation by those financial planners to get a hold of your money. They're
Right.
not really thinking of the end result to you. A lot of times they're looking at a product that they want to sell or assets under management so they could sell their practice, things like that. They're not really looking at it saying, I want to create a cash flow machine for my client.
That wouldn't benefit them.
It
Yeah.
wouldn't benefit
Right.
them. Yeah. If I'm sitting there looking at, hey, I could manage your money, doctor. Um, or hey, realistically, you need to go buy some real estate over here. Some of them are set up to maybe take a benefit on some of the syndications, but then the syndication isn't as effective. So realistically, they're not going to put you there. It gets maybe a money manager who's charging you like a set percentage, like, hey, I'm going to charge you 1% to manage your portfolio. They may take you into some of the syndications, but for the most part, it's going to be, they're going to put you into mutual funds and things like that and say, hey, we're getting you the same thing. And it's no, what they're getting you is an extra, they're going to pay themselves 3 to 4% on top of whatever the costs are on the thing. And, you're going to walk away with a lot less. I ran the numbers on a 4.8% management fee. If you made $1 million of gain, 680 of it is going to the financial planner. So they actually make more money on your money than you do. So you want to get away from that. Yeah, get away from that. Run like the financial planners. They come dressed in a nice suit. Just sometimes your best bet is to turn it and run.
Well, yeah, I mean, what a great business model though, because what are the business model, that you know of that you can, doesn't matter if your client or customer does well, you're still getting paid.
Yeah.
It's kind of like, hey, I'm a coach. It don't matter if I go 0 and 12, I'm still getting paid. Who cares if I win or lose, you know?
It's like the prime minister over there in the UK. She was in there for what, Tuss? She was in there for 6 weeks, but she's going to get income for life. All she had to
Yeah.
do is become the prime minister. She qualified. She's like, I'm out.
Yeah.
Crash
See
the
you later.
market. Cost a few $billion, but I'm good.
Well, Toby, I really appreciate your time today and your wealth of knowledge. If people want to learn more about you, what you have to offer, anything like that, where can they go?
Just type my name in the internet, and like you did, just join the YouTube channel. It's free. I promise you, you won't be disappointed. You'll get good content all the time. I tend to be I do this because I love it. It sounds like you're doing stewardship for young people too. That's where Infinity Investing came from, is just trying to get to people before they become indentured servants. I let's at least give you the key to the golden cage so you can just choose to let yourself out. But better yet is, let's not get in the golden cage in the first place. And so you got to reach people before they get into college, because by the time they're there, they're getting so much pressure to take on debt. And it's so suffocating and so harmful. I'll leave you with a thought, because somebody that I respect in real estate said, hey, you know what? I've never seen a foreclosure somebody who didn't have a mortgage.
That's true.
So it's like,
My son's a senior in high school, and there's not a week that goes by he doesn't get something in the mail from a student loan company, Discover Card, American Express, whatever. It's just like and he's not even 18 yet. So it's just, you're right. Once they get into college, it's like debt, 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 you know?
they don't even hide it. It's called the master card. So
Yeah,
who's the servant? That's all you got to ask yourself. It's
that's
like
true.
they're pretty blunt about it. It's
Yeah.
just a lot of times we don't have anything to arm ourselves with to try to say, maybe I shouldn't. Maybe I shouldn't do that. Maybe I should work and buy my assets as they
That's
go.
right. Well, folks, the book is Infinity Investing. The author is here, Toby Mathis. I will put links below this video for his website, for his YouTube channel. So I'll make it as easy as possible for you to find that. So again, Toby, thanks a lot for your knowledge. I really appreciate it.
It was a blast. Thanks for having me.